Assalamualaikum. We meet again, this time for the topic of pricing decision. So I'm your lecturer, Dr. Lizz. So welcome to pricing decision. Are you ready to start your lesson? Let's go. Okay, so first of all, what is pricing? So I'm sure that when I say pricing, everybody can imagine on what is pricing. So yes, you are right. Pricing is actually setting the price for your products. Okay, how are we going to set the price for our products? What price are you going to charge your customers for 1 unit of product that you want to sell? So, is it a difficult thing to do, or is it something that is quite easy to do? Well, in fact, setting the price for the product is a very difficult thing. You know why? Because it will determine how well customers will accept your product. So it will determine how long will your product be in the market. Okay, so that is why when we talk about pricing, then we are talking about something important. Yes, it is something very important. You know why? Because it determines how well your product will compete in the market. So how long will it be in the market? How customers will respond to your product? So why can't we just follow the market price? Why can't we just look at our competitors' product and follow their price? So of course you can do that, but that is something very risky because you do not know for your product what is the cost to produce the product. Why do we have to follow our competitors? Because competitors might use different technology, might use different materials and so on. So the cost of our product will be different from their product. So that is why we must have our own strategy to set the price for our products. Okay? And so, what about the methods? Is there any methods that we can use so that we can help the companies to determine the price of their products more strategically, okay, more precisely, so that we can guarantee that the company will earn some profit from it? There are 3 methods basically, as you can see here. So we have full cost plus pricing. We also have marginal cost plus pricing, and the last one is what we call minimum pricing. So remember that there are 3 methods that we can use. Number 1 is full cost plus pricing. Number 2 is marginal cost plus pricing, and the last one is the minimum pricing. Okay, so we are going to look at this method one by one after this. Okay, so first of all, we go to full cost plus pricing. This is the full cost plus pricing. So under full cost plus pricing, the price here is determined based on full cost. So as you can see, we have full cost here. So what do we mean by full cost? What we mean is all costs involved in the manufacturing of the products will be considered before you can determine the selling price. This will be the base. Okay, so when we look at our full cost plus pricing, we have price is based on total full cost. What do we mean by total full cost? Total full cost means whatever cost involved must be considered to determine the selling price. Just imagine that you are actually manufacturing a product. So what are the costs involved? Number 1, of course, it will be the direct material cost. Then we have the direct labor cost, we have variable manufacturing overhead cost, we have fixed manufacturing overhead cost, we have variable selling cost, fixed selling, and also fixed admin costs, because normally administrative costs are all fixed. Okay, so when you total up all these costs, you are going to have the total cost. So these total costs already include the manufacturing costs, include the selling costs, include the administrative costs, whatever cost incurred in the manufacturing of the product, it will be included here. So you will get the total cost. Okay, and the selling price will be determined after you add some profit markup to the cost. Okay, so you will get, let's say the total cost here is 100. If the total cost here is 100, okay, let's say your total cost is 100. Profit markup then, let's say, is set at 20%. So your profit markup will be 20% from 100. You will get 20 ringgit. Then the selling price will be 120 ringgit. So based on total full cost here, okay, total cost of 100 with 20% profit markup, you will get 20 ringgit profit, and the selling price will be set at 120. So this is the price that you are going to charge your customers for 1 unit of your product. Okay, still based on full cost plus pricing, we have another method that we call total production cost. The price is based on full cost plus. However, instead of taking the total full cost, we just only want to focus on total production cost only. Okay, so when you read the question, make sure you read the question carefully. Does the question say, is it the total full cost, or is it just based on the production cost only? So if it is based on total production cost only, then you have to be careful, because here these are the costs involved, all costs involved in the manufacturing of a product. So you just need to choose the total production cost only. So among these costs, there are certain costs that are not related to production costs, and these costs you just have to get rid of. You shouldn't consider them. Okay, now let's go through one by one which are the production costs and which are not the production costs. Okay, so let's see. This is the direct material cost. Does it involve in production cost? Yes. So you have to include this one. Then we go to direct labor cost. Does it involve in the production cost? Yes. So you need to include this. What about variable manufacturing overhead cost? Does it involve? Yes. So you will include this. Fixed manufacturing overhead? Again, yes, it is a manufacturing cost. What about variable selling? Is this the production cost? Obviously no, because it is the selling cost. So this one cannot be included. So you will have to get rid of this. Okay, fixed selling is also the same. This is not manufacturing, so you cannot take this. Okay, fixed admin, again, it is not manufacturing. So you have to exclude fixed manufacturing costs. So our total production cost will normally consist of only these four: direct material cost, direct labor cost, variable manufacturing overhead, and fixed manufacturing overhead cost. Okay, and because of that, you are going to get the total production cost. So if I am to, here you are going to have total production cost. Okay, let's say the total production cost is only 80 in this case, and if the profit markup is still 20%, or 16 ringgit, okay, instead of 20, then the selling price will only be 96 ringgit. So, can you see the difference in the selling price if you use the total full cost, which is 120, and if we use the total production cost, the selling price will only be 96, because total cost will of course be more than total production cost, because some of the cost elements here will be eliminated. or will be excluded from your calculation. So that is why the selling price will be lower than the total full cost. Okay. So when actually do we use the full cost plus pricing? Why do we want to charge lower price then? Okay, so if you look at your book also, you can see that full cost plus pricing is used when products are made based on specification by customers. Means that your customers come to you and tell you that they want to have this kind of product, then normally we choose the full cost plus pricing. Okay, and then it is difficult to make estimation, so that's why we include all costs, because it is very difficult to absorb costs and so on, so we just take full cost. Okay, and also when the main objective is to make profit after making sure that fixed costs are covered. So in the normal operating situation, normally we use the full cost plus pricing, and also maybe because of the demand pattern is difficult to predict. You cannot predict when the when the demand will increase, when the demand will go down. The product is not seasonal, so it is difficult for you to predict. So at this stage, it is always more appropriate to use the full cost plus pricing. Okay, so why do we use the full cost plus pricing, or the advantages of using the full cost plus pricing? So as you can see here that full cost plus pricing is easy to use. Why is it easy? Because you take all costs. You don't have to choose which cost is to be included, which cost is not to be included. Okay, number 2 also is because of it is standardized. So it is always easier to do something that is standardized, something that you just have to follow, because that is already the form, the norm. Okay, number 4 also because it is safer. Why? Because it already covers here the fixed cost, the variable costs are already covered here, so you don't have to worry that your price might be too low, that it might not be able to cover the fixed costs and so on. And then because of you can avoid having the difficulty of estimating demands, like when we look at when just now, as when the demand pattern is difficult to predict. So this is a safer approach actually. Okay, and then another one is why not? Means that what are the disadvantages of using the full cost plus pricing? So sometimes people don't use the full cost plus pricing because it ignores competition. Okay, so here number 1 you can see that it ignores competition. Okay, ignores competition, what do we mean? When we say that it ignores competition, it means that you don't really respond to demand, supply. Okay, people are competing because you use that particular price. If you go to supermarkets, if you see that near the festive season, Hari Raya, there are promotion or sales going on, so the price has been increased or decreased. So if you use the full cost approach, normally we do not respond to those promotion. The price is fixed at that for all time. Okay, so that's why we say that it ignores competition. And also it is not sensitive to price elasticity of demand. Okay, because it is price elasticity, it ignores. Okay, so when we talk about price elasticity, so demand goes up, the price will stay the same. If the demand goes down, the price is still the same. You do not change the price to reflect the level of demand. That is the price elasticity. So that is somehow not good, because normally people will respond to the demand, so they will change the price accordingly. Okay, number 2, when there is a tendency to set the price based on inaccurate cost estimate. So overhead costs are actually very difficult to accurately absorb. So this problem will result to some products being unfairly underpriced and some may be overpriced because you include all variable and also fixed costs. Okay, and fixed cost plus full cost plus pricing is also not suitable for short-term decision, okay, because it ignores the distinction between a relevant and irrelevant costs, because normally fixed costs are irrelevant costs. So that is the advantages and also disadvantages of full cost plus pricing. Okay, the second method that we have already seen is the marginal cost plus pricing. So this is the marginal cost plus pricing. Okay, just now we talk about full cost plus. The second method is marginal cost plus. Another name for marginal cost plus is variable cost plus. So you can see that when we say marginal, then it means variable. So marginal cost plus is also another name for variable cost plus pricing. So under marginal cost plus pricing, the price is set based on total variable cost. Just now, full cost plus pricing, the price is based on full cost. But then for marginal cost plus pricing, we only focus on the variable cost. You see, we only focus on the variable cost. But like the full cost plus pricing, the variable cost plus pricing also focus on two. Okay, almost the same. That is, the first one is total variable cost. Total variable cost means all variable costs will be included in setting the price of the product. But when we focus on variable production cost, then we only focus on the production cost only, just like the full production cost. Okay, so let's see the difference between these two. Now, let's say this is the cost that we have. Now, we want to look at just only the total variable cost. So, direct material cost. Is this the total variable cost? You have to understand direct material is a variable cost. So yes, this one will be included. And then after that we have direct labor cost. Yes, this one will also be included. Variable manufacturing overhead cost. Yes, of course, because this is variable cost. Fixed manufacturing overhead. As you can see, this is fixed. Fixed means it is not variable. So this one we will have to cancel. We are not going to include it. Okay, what about variable selling? Variable selling is also variable. As you can see, the name is also variable. So here, this is also part of the cost that you are going to include in your calculation. What about the fixed selling? Fixed, the name is already fixed, so we don't want it. So we are going to exclude it from our calculation. Fixed admin, same thing here. It is not variable, so we cannot include it in our calculation. So our focus now will only be on the direct material cost, direct labor cost, variable manufacturing overhead cost, variable selling cost, and that's all. Okay, what if the question gives you more on the variable cost? So of course, you just have to include that even though they are not listed here. So long as it is variable, then you just have to include it as part of the cost for you to determine the selling price. Okay, so when you add up all these costs here, so we are going to have 1, 2, 3, 4. So you are going to have the total cost here. So this one will be the total variable cost. Okay, total variable cost. Let's say in our example, our total variable cost is only 60. Okay, so how much will be our profit markup? Let's say the profit markup here is 30%, because if we use the variable cost plus, then the profit markup will of course be higher than the full cost plus pricing. Okay, so 30% will be about 18 ringgit. So the selling price that you are going to set here will be 78 ringgit. So this is your selling price. Okay, so what about the variable production cost? Okay, so here we are going to base our calculation based on the variable production cost only. Just now we are going to take the total variable cost, but now we just choose variable costs which are related to the production only, and that is going to be the basis for our calculation to set our selling price. Okay, direct material cost, is it production cost? Is it variable? Yes. So we include direct labor cost, again, variable manufacturing overhead. Yes. Fixed manufacturing? No. This is not variable. Variable selling? No, because this is not the production cost. Fixed selling? Definitely no. Fixed admin? Definitely no. So as you can see, we only focus on these three costs only, which are direct material cost, direct labor cost, and variable manufacturing overhead cost. Why? Because the method that we use is variable production cost only. Okay, so you will get here total variable cost. Okay, you will get the total variable production cost here. Okay, so let's say the total variable production cost is only 50 here. Profit markup will of course be higher. Let's say the profit markup will be 50%. So you will have here 25, and then you will have 75 ringgit. So that will be your selling price. Okay, so I hope by now you can now compare the difference between full cost plus and marginal cost plus. And under full cost plus, then I hope that you know that there are two bases. Sometimes the question require you to use the total full cost. Sometimes the question also require you to use production cost only. Same thing with marginal cost plus. Sometimes the question asks the total variable cost. Sometimes you just focus on the variable production cost only. Okay, so I hope that you can understand this. So now we want to see why actually do we use variable production cost when obviously it will give you the lower price. Okay, why do companies use marginal cost plus? This is the reason. As you can see, when we just look at the marginal cost, then we are actually talking about contribution margin. Okay, so we have looked at it previously. Before this, we go for the concept of contribution margin. Okay, it is actually the contribution margin that you can control. When you increase your efficiency, then contribution margin can be increased, and because of that, it will lead to the higher profit. Okay, so it will highlight the importance of contribution. And number two, it is more useful when you want to tender for contract, because normally if you use the full cost plus pricing, the price is normally static. You cannot really change it because it's standardized. But when you want to go for special order to fulfill your excess capacity, then we use the marginal cost plus pricing, because we are actually operating at the same fixed cost, but we just want to utilize our excess capacity. So marginal cost plus pricing will be useful there. And the next one is because companies, it is difficult to absorb fixed cost to the product. So when you use the variable cost plus pricing, then you don't really have to consider the fixed cost. Sometimes wrong absorption rate will lead to the high price that the customers cannot pay, are not willing to pay, so the company will suffer. So if we just base our price based on the marginal cost or variable cost, then it will be easier for us. Okay, so why not? That is the disadvantages. Why people are not using marginal cost plus pricing. Okay, so as you can see, there is a danger. If you choose the marginal cost plus, then there is a danger. What kind of danger? Danger of you not to be able to cover the fixed cost, because we base everything on variable cost, so we ignore the fixed cost. What happens if you set the price that is too low that you actually cannot even cover the fixed cost? So in the long run, this is not a good pricing strategy. Okay, so we don't want to run a business knowing that we cannot cover all costs. Okay, and the next one also, when the fixed cost is too high. You imagine your fixed cost is too high, your variable cost is rather low. So when you use the variable cost only to set your selling price, then it is not suitable for this kind of business, because we are afraid that we might not be able to cover the fixed cost. So again, the danger is there. So that is why marginal cost plus pricing is normally used for short term only. That is when you want to determine the selling price for festive season, for example. You want to give offer price to your customers, then you will use the marginal cost plus pricing. But then in the normal operation of a business, you are going to use the full cost plus pricing. Okay, so now, is there a difference between a profit markup? As you can see just now, we're talking about profit markup here. 30% profit markup, 50% profit markup, or profit margin. Is there a difference between these two? What is profit markup and what is profit margin? So you really have to understand this. When you read the question, please read the question really carefully, because there is a different treatment for each of these. When we say profit markup, then it means the rate of 30% here will be times with the total cost. Okay, the total cost. But then when we say profit margin, then the 30% rate here will be based on the selling price. So that will become such a very significant difference that will differentiate your answer. So please be very careful when you read the question. Does the question say profit markup or does the question say profit margin? Now we look at this illustration. Okay, if the total cost is 1,000, what is the selling price if profit markup is 20% or profit margin is 20%? Are we going to come up with the same selling price? Okay, because we are using the same rate here. Okay, so let's see. We try to do this question. We look at the first one. It says that if the total cost is 1,000. If the profit markup is 20%, remember the profit markup, 30% or the percentage, we must time it with the total cost. So here, plus with profit markup. 30% here, 20% here, you must times it 1,000. So you will have 200. So your selling price here will be 1,200. This is the case if the question asks for a profit markup. Okay, the profit markup here. So that is what you need to do. 20% rate times with the total cost here. But then, if we try to answer the second question, that is when the profit margin is 20%, so how will it look like? Okay, so let's get rid of this first. Okay, remember, if the question asks for profit margin, so what you will need to do now is you will need to take the rate given, 20% in this case, times with the selling price. Okay, so total cost, let's say, total cost given by the question is 1,000 plus profit margin here is 20%, which is 0.2. You still do not know how much is it. Okay, and selling price here, we still do not know. So how come we calculate the profit margin of 20% here if we still do not know the selling price? Because it says that to use profit margin, the rate here must be multiplied by the selling price. Okay, so we assume that total cost here is actually 80%, profit is 20%, and selling price here is 100%. So what to do is that you just take 1,000, you divide by 0.8. Okay, so you will get the answer 1,250. Okay, so selling price is 1,250. That will give you the profit margin of 250. So as you can see, this is the difference when we use profit markup as compared to profit margin. Profit markup 20% will give you the selling price of 1,200, but then the profit margin of 20% will give you the selling price of 1,250, which is higher than the profit markup. Okay, so when you read the question, please be very careful. Make sure that you can see clearly whether the question asks for the profit markup or the question asks for profit margin. Okay. Okay, so this is the last method that we have, which is the minimum pricing. Okay, so what is minimum pricing? Minimum pricing. It looks like when you say here, people say minimum pricing, then you know that this is the most minimum price that you can go. You cannot go lower than this price. Okay, so of course, that is what we mean by minimum pricing, which is the lowest price to sell your product. You cannot sell lower than this price. Okay, so that is minimum pricing. Because of this is the lowest price that you can go, then at minimum price, you will gain no profit, but you will not incur any loss. So in other words, we are saying that minimum price actually break even price. Yes, if you sell at this price, you will not gain any loss, you'll not gain any profit, but you will not incur any losses. So what does it mean? It means that your price here is equal to the relevant cost to produce the product. Okay, so when the price is equal to cost, then of course you will get no profit. At the same time, you will incur no losses. So that's why we call it break-even price, which is our minimum price. Okay, so how do we determine the minimum price? So there is a formula actually of how to determine the minimum price. So when you just follow this formula, then it's gonna be easy for you. It's not confusing. It's just a straightforward formula. So please understand it carefully, and then after that, I'm sure that you can answer any questions that may come. Okay, minimum price, the formula is variable cost incurred. That is, if you want to produce a product, what are the variable costs incurred? I am sure that you can still remember the cost to produce, the variable cost to produce the product must include the direct material, must also include the direct labor, must also include the variable manufacturing overhead, and if there is any relevant variable selling expenses, then you just have to include it here also, or any other things that are variable that the questions might give you. So you must include it here because these are all the variable costs. Okay, and then you are going to plus it with the incremental fixed costs. What are these incremental fixed costs? For example, these are the specific fixed costs that you might need to incur just to make the minimum, to sell the product at the minimum price. Okay, why? Maybe you want to entertain the special order. So you just want to sell at the minimum price because of certain reasons. Okay, so what are the incremental fixed costs? Maybe you will need to rent another operator. Okay, you want to rent a machine. So this is the incremental fixed cost. Maybe because of that, you will need to pay the transportation. So this is the incremental fixed cost. Or maybe you need to pay for the insurance, especially just for accepting the special order. So these are the costs that you need to include, okay, to determine the minimum price. And then after that, plus here with the opportunity cost. Is there any benefit that you might forego because of you want to accept this special order? So if there is, then you just need to include it here, plus it with the incremental cost, plus it again with the variable cost, then you will get the minimum price. So that is how you calculate the minimum price. Okay, so class, I hope that you can understand the minimum pricing. So that's all for the topic of pricing decision. I will see you again in the next video. And in the meantime, I want you to do question 5 on Kashmir Berhad. Okay, thank you so much. I will see you again for the next video. Bye.